Hi, I am Professor Milligan. Welcome to my weekly series, Wall Street Wednesdays. I record this series live every Wednesday from 1 to 2 p.m. Pacific Standard Time on my Instagram account at Professor Milligan. Welcome to join me there or listen to the recording here. Good afternoon. The bell just closed. The market closed. I'm looking now down, looks like 270 and change. Actually, market hasn't closed yet. I'm a little early. All right, so now I'm on time. So, hey guys, I want to thank you all for showing up. A lot of interesting things going on. So we'll talk about it. Had a few questions that were DM'd to me. Remember, guys, if you have any questions that you want to ask, you're always willing. I'm always willing to answer questions online. I will do my best to try and I get some in the direct message that I actually reply back to. But again, I'll talk about it while I'm here. All right, excuse me. So let's, where shall I start? So let me start with a couple of things. Let's start with the economic news, and then I'll work my way back. Again, the only reason why I'm talking about the economic news is I believe that the economic news can help us make some money, and that's what the whole goal of this is. So today, Chairman Powell of the Federal Reserve announced that they were going to keep the federal funds rates where they're at, between 0 and 25 basis points. For my newbies, 25 basis points is 0.25%, 0.25. So that's how we speak in basis points. One full percentage point would be 100 basis points. So the Fed said they're going to keep rates down to between 0 and 25 basis points, and they foresee doing that until 2022. So it was an interesting call this morning, I should say today. Market rallied a little bit, then it sold off that news. Now, for those who don't know, the number one tool for the Fed to fight inflation is interest rates. It's the federal funds rate. The federal funds rate is the rate that banks borrow from each other overnight. So if it costs more money for the banks to borrow money, then they're going to charge us more money. The other thing about this, though, is that it really affects corporate America. So the reason why the Fed is keeping these rates down this low is they're doing everything in their power to stimulate corporate America. So basically, corporate America can borrow money right now, short term, at basically no cost. And then what they do with that money is, hopefully, they take that money, put it into projects, capital expenditures, new equipment, new projects to try and grow the business, grow the value of the business. So what the Fed is doing is, by lowering interest rates, they're trying to stimulate corporate America, which will stimulate our economy. So that's what the Fed's trying to do. Over the past, guys, I want to say since this pandemic has started, there's been a disconnect between the market and our economy. So right now, I think all of you know, we've got, unemployment. I'm not sure where it is. Last I heard was 15 million, but they could be off by another 5 or 6 million, so it could be higher. But the one thing we know is that we're at record levels of unemployment. Yes, the economy, or the U.S. economy, markets are back open, but at the same time, we know that because of the protests that we have, we've also seen a spike in the coronavirus pandemic. So why am I saying all this? What I'm saying is I have no idea how this market is doing what it's doing. So let's back up a little bit. If you're a long-term investor, you brought the dips, you're sitting there holding. If you're a trader, you've been trading this market. One of the things I tell my traders is do not fight the tape. If the overall trend in the market is going higher and you're trading it, then go with the trend until it doesn't work. Now, for me, I'm finding this market somewhat scary. And the reason being is, we talked about this last week, and that is, one of my strategies is what I call buying stocks that set new highs on increasing volume, where these stocks have increasing growing revenue and increasing growing earnings per share. All right, that's one of my strategies. So I went and looked in the market. I keep looking in the market, and there are a number of stocks setting new highs. Apple set a new high, Amazon set a new high, Microsoft set a new high. But what's interesting about this is they've all set new highs, and volume is less than the average daily volume. Now, I'm not sure if you understand this. If you talk to any investor trader that uses any type of technical analysis, they're going to tell you that a true breakout, when it can hold itself, sustain itself, there's power behind it, comes from an increase in price as well as an increase in volume. One of the things I look for when I look for a stock that's going to break out, and what I mean by breakout is when a stock is trading and all of a sudden goes from 20 to 25, 30 in 2 or 3 days. All right, that's a breakout. Those kind of moves come on heavy volume. A quick reminder, institutional investors dominate the market. So when they step in and decide that they want to buy a stock, they're going to buy it and buy it in volume. They're not like you and I. They're not buying 1,000 shares, 2,000 shares, 5,000. They're buying a couple 100,000 shares, maybe even 1 million shares or more. So that type of volume when they buy gives you support. The last 2 or 3 weeks, I keep looking. I looked again today. Couple things. It was 5-1 losers in terms of new record low, down stocks to up stocks today in the marketplace. So let me explain that again. Down stocks to up stocks. The down stocks, there were 5 times as many down stocks as there were up stocks. First thing I look at. Second thing I looked at, the volume on all the stocks, the Microsofts, the Amazons, the stocks that have carried the market, the stocks that you and I look at. All this is going on, and these stocks are doing that, and they're doing it off of average daily volume. What that means to me is that there's no strength behind this push. It means that the market's moving up off of what I call vapors. Now, earlier this week, I had a long conversation with one of my friends / clients / business partners. And one of the things that I explained to him was that institutions do not buy stocks to flip them for a point or 2 points or 3 points. Institutions buy stocks that they believe in 6 months, a year, 2 years are going to be significantly higher. All right? That's how they make their money. The second thing about institutions, which is really interesting for us, institutions have a different playbook than you and I. Here's the deal. Most institutions have to stay long. They have to. All right? What do I mean by that? If you're a portfolio manager, and as I look, I got a few of my former students on the call right now that are current portfolio managers. If you're a portfolio manager, you cannot go to all cash. You must be 100% invested in the market, which is what you told your clients. So I want you to think about that for a minute. If you're a portfolio manager, and I'm going back now, I gotta get my years right. I'm going back now to 2001 when the dot-com bubble was going on. I'm in Santa Monica. I'm in a friend's office, portfolio manager. They manage $5 billion. All right, that's what they had in the management. He and I sitting here having a conversation, and as the conversation went, he and I both agreed that the dot-com stocks, the market overall and the dot-com stocks, were all overextended. I mean by overextended means the prices were way too high compared to what the company was actually worth. And a lot of you guys that might have been around at that time saw it. Basically, you buy a dot-com stock in the morning, by evening, sell it up 40, 50%. That's how those were moving. So I'm talking to him, I'm saying, look, you and I both, and he agreed with me, he said, I think the market's way overvalued. I think there's going to be a major correction. And I said to him, I said, well, why don't you go to cash? And he said, Mike, my investment policy committee will not allow me to go to all cash. I'm a portfolio manager. In our prospectus, in our memorandum, it states that we will be 100% invested. Then he went on to say to me, he said, if we liquidate these positions and go to cash, I've got to send investors back their money. And I make my living off of the fees I charge for the amount of money I have under management. So what he did was, and he didn't like it, but he had to stay fully invested in the market. Even when the market started to correct and crash in 2000, 2001, he still had to stay fully invested. Our advantage is we can go to cash. We can go to cash in 30 seconds. So why am I telling you all this? I'm telling you all this because the institutional investors are moving this market, and they're moving it off of no volume. They haven't sold any positions, and they keep moving it up off of no volume because they do not want to lose you as clients, one. And two is, that's how they make their living. They have to be in cash. You and I don't, all right? Make sure we're clear on this. So you can stay fully invested in this market. You can buy stocks that are going higher off a weak volume. I don't do that. I wouldn't do it. If you're currently fully invested, then stay fully invested. But all I'm telling you is keep an eye on the market, keep an eye on what's going on, because these institutions have artificially stimulated this market, and at some point it's going to correct. That's what I do know. Now, I had a question that said, and it was from Twin. So I got to read my question from Twin. Twin, how you doing? Question was, do you think there will be a large downturn in the market once the second quarter earnings start to come in? The thing I will say to you is this. I don't think anyone can accurately time the market, including yours truly. If I could accurately time the market on a regular basis, you guys wouldn't know me. I wouldn't be on this call. I'd be on my yacht somewhere, me and my wife, cruising, because I'd be able to actually forecast the market. I'd be the richest man in the world. All right, I can't do it. No one can do it. But here's my thought process. Couple things going on. You saw today a number of the airline stocks come down and get hit. You saw today a number of major corporations, Starbucks one that comes to mind, that came back and lowered all of their numbers for the current quarter they're in. Here's my disconnect. How can the market be at an all-time high when the economy is struggling? When we're not going to be back to where we were 3 months ago? Starbucks is not going to sell as much coffee as it did 3 months ago. A lot of these companies, they're guiding numbers down. So if numbers are coming down, but the price of the value of the stocks are going up, are you telling me that at the current levels we're at, we were undervalued? And I don't think so. So when earnings come out this quarter for the, excuse me so much. When earnings come out for the current quarter that we're in, I think that you're going to see a lot of guidance guiding numbers lower. The thing that's going to be interesting is that certain companies are going to do really well. The communication industry, we're all Zooming now, we're all telecommunicating, we're all conference calling. So you're going to see those industries that basically allow us to stay at home or work from home or do things where we don't have to actually be in the same room or socialize with other people. Those companies are taking off. But how long is that going to carry through? Now, so to answer the question, I think, so I gotta really back up now. And I don't like getting involved in politics. My goal here is to make money, show how to make money. But here's what I think. I think that the current government is holding up the market. I think the current government, and don't get me wrong, previous governments have done the same thing, are pumping money into the marketplace, pumping money into corporate America to keep corporate America afloat. The challenge I have with that is that how long can they keep doing it? How long can the U.S. government keep printing money? How long can the U.S. government keep bailing them out? You and I both know, based on common sense, that revenues for most of these corporations are going to drop. They have to. And even though we've opened back up in the country's opened again, the problem we have is that we're still not back to where we were before we closed the country. And the second thing is, even when we open it back up, which we did, the environment's changed so much that corporations have to make adjustments. I don't think you're going to see these earnings continue the growth they had, at least for this quarter next, in some of these companies. The other thing I found interesting was the number of people out there that are buying airline stocks, that are bottom fishing. There's a reason why the cheap get cheaper. So let's think this through. Airline stocks, their revenue comes from them actually booking seats. The airlines now have gone to this different pricing where they charge you for a ticket, then they charge you for your luggage, and they charge you for this, and they charge you for that. And they're doing that to try and increase revenue. And that's based upon them having planes at full capacity. Now with social distancing and the fact that more people are social distancing, is it safe to assume that these airlines won't be back to where they were pre-coronavirus? It's a safe bet. The other thing that's interesting about the airline stocks is the airline stocks were not high flyers in the first place. And they have a problem. And the other problem they have is that oil prices have moved back up. So with the social distancing, with the fact that they can't be at 100% capacity anymore, they can't stuff these planes like they were, I find it hard to believe that these airline stocks are going to actually reappear to where they once were. And if you saw the airline stocks then you track, the airline stocks sold off today. I just don't see it. So going back one more time, institutional investors, hedge funds, mutual funds, pension funds, they are not short-term traders. When they take a position in a company, they're taking a position for the long haul. All right? They will never go to cash. You will never hear Wall Street say, Mr. Smith, Mrs. Smith, the safest place for you to be right now is all cash. The safest place for you to do is to sell your stocks. So I want you to keep that in the back of your mind as you watch these portfolio managers and analysts on the financial channels talk about how they're adding to their position. They're dollar cost averaging on the upside. They're buying stock, they're buying more stock and increasing their cost basis. But if you're long 1 million shares, another 10,000 shares is not going to have that bigger impact on your portfolio. But it will have a big impact on the market and the stocks. Now, I hate to say this, I'm not a conspiracy theory guy, I'm not a commingle guy, but these institutional investors have gotten together as a group and they're pushing this market. So I read a nice article that kind of supported what I believe, and I'm going to say it real quick and then we're going to move on. One, I think that if the market starts to realize that President Trump is not going to be reelected, and they do that before the election, I think the market's going to sell off. I think Wall Street's just going to sell off. Wall Street really does support Donald Trump because of what he does for corporate America. They really support him. I believe that if it looks like he's going to lose and Joe Biden is going to win, this market's going to sell off before the election. If we go to the election and the market keeps running higher, if President Trump loses that election to Joe Biden in November, buckle up, guys, because it's going to hit then. Because in order to fix a lot of the problems that we're having, it's going to require the U.S. government to raise taxes. It's going to require them to lower interest rates to basically zero, where he says he's going to keep them for the next almost 2 years, a year and a half. It's going to require him to do a lot of things that's going to hurt the individual investor and hurt the stock market because of the disconnect. All right. Now, so we got that. You know how I am. Let me see. Let me check my time. Hold on a second. Checking my time. So I got a lot to cover. All right. So, this went off. All right. All right. Let's talk about PE ratios. PE ratio is a price earnings ratio. All right. PE ratio. It's one of the I'm going to give you a simple use of this tool, but almost every major firm on Wall Street, when it comes to valuing stock, are using some type of ratio. We call it market ratios. One of the most common, most popular ratios is PE ratio, price to earnings ratio. All the ratio is they're going to take the current price of the stock divided by the earnings, the annual earnings, and they can come up with a ratio. So let me give you an example. Let's say your stock is trading at $20 a share and it has earnings of $2. $20 a share divided by $2, we got a PE ratio of 10. So investors are willing to pay 10 times earnings for this stock. Let me say it again. Price is 20, earnings last 12 months are $2. 20 divided by 2 is 10. We've got a PE ratio of $10. It means investors are willing to pay $10 for every dollar in earnings. All right, you got that. Let's go a little further. Let's say that you're forecasting for the current year of earnings per share to be $2 and let's see, what am I going to make this at? $2.50. So you're forecasting that earnings are going to increase from $2 this year to $2.50 by the end of the year. So we're looking at basically $50. We're looking at a 25% bump in earnings. Therefore, we take that $2.50 and times it by a PE multiple of 10, and we expect this company to trade at $25 a share. So again, I'm going to do it all over again. I'm going to take the PE ratio that the company's been trading at. I'm going to take that and apply it towards the forward earnings that are estimated by Wall Street. Wall Street's estimating $2.50. We have a PE multiple of 10. Stocks should go from $20 to $25 a share. All right. It's one of the ways Wall Street will come up with the value of a company. That's the reason why when corporations start announcing their earnings and we sit back and watch, we take those numbers, we drop them into our calculators real quick, and we come up with what we think the stock is worth. If the earnings drop, if the earnings go from $2 down to $1.50, I'm going to take that $1.50, multiply it by 10, and now I'm saying I got a $15 stock. All right? That's what goes on here. Now, let me take the P ratio one step further. P multiples expand and they can contract. Multiples expand in bullish markets. When the market's going high and bullish market and the economy's doing well and the company's doing well, you'll see that multiple expand because investors are willing to pay more for it. In a bearish market, when the market's going down, the company's not doing well, bad news in the economy, bad news in the market, bad news in the stock, that multiple will contract. So if that multiple contracts, even if we earn our $2.50, the stock price is going down. All right, you got that. Now let's go a step further. PE multiples are highly correlated to growth. The more Wall Street expects a company to grow, the higher the multiple they're going to apply. So your high growth companies, by the way, Amazon today set a new high off of below its average daily volume. All right. Again, I can't tell you enough. I've been doing this for over 30 years. The thing that I've seen the most is that when you have stocks running to new highs off of light volume, I'm telling you there's not much support underneath that. And one little shake, one little crack, and those things are going to fall apart. For 30 years, I've been trading earnings based on volume and breakouts. And I'm here to tell you something. When there's no volume on these breakouts, be careful. I won't do it. I just won't do it. So yes, I'm looking at a lot of stocks that are setting new highs. I'm looking at them. I go back to the volume. I'm looking at the chart pattern. Technically, I'm like, the chart looks good, but I got a problem with the fundamentals, but I got even a bigger problem on my short-term trading with the fact that there's no volume behind it. All right. So we talked about PE ratio. We talked about how they can expand and they contract. The other thing that you'll know is the higher the growth in earnings per share, typically the higher the PE ratio. So if you take a company that's their earnings are growing at 30% per year, maybe make sure you understand what I mean by that. If it was $1 last year, we expect them to be $1.30 this year. All right, we expect those earnings to grow by 30%. If you're expecting growth to be at 30%, then most likely that PE ratio is going to be somewhere close to 30. If you're expecting growth of 10%, most likely you're looking at a PE ratio that's going to be close to 10. So let me back up a little bit again. For my aggressive investors who are looking for stocks that seem to be growing really fast and growing and have tremendous growth potential upside, you're looking at companies that typically have a high PE ratio. I don't buy stocks based on the PE ratio, but I do look at it. So, my long-term conservative investors, most likely the stocks that you're looking for that have what we call good growth, paying a dividend, total return, typically have a lower PE, 10 to 12, 15 times earnings. You look at some of your higher growth stocks that that we all like. Don't get me wrong, when I say you guys, I like them too. That's what I go after. The Apples, the FANGs, Facebook, Apple, Amazon, Netflix, Microsoft, Google, which is Alphabet now. I look at those stocks, and those stocks typically have a PE ratio of north of 20, 30, could even be higher. So real quick, wrap it up. One of the indicators I look at is PE ratio. I do not buy based on PE ratio. I just look to see what's going on with the company in terms of earnings and what it's trading at. The reason why I don't trade based on PE ratios is because PE ratios reflect what's going to happen over the long term. And if I'm a short-term trader, I look to see what's going on. I want to see a company that's growing, its stock price is increasing, and I'm going to try and figure out the best time to enter that trade. That is PE ratios. All right, now, let me see what else I have. Everything I've said to you today, my goal behind this is to make money. All right, we have to take this information and use it and see how we can benefit from this in terms of making money. Now, before I forget, I'm looking here. Bear with me, I have my notes. All right, I talked about that. Cool, I got that covered. All right, so one of the other things, and I told you guys I would do this, and some of my students, former students I see that are on here, we've talked about this in the past. And one of the things I'm going to talk about now is I also am looking into the commodities market. So one of the things that I want you to understand is that what's interesting to me about the commodities market, for me, I'm a trader. All right, I have some long-term investments, but I'm also a trader. One of the things that's interesting to me is that I can always find a commodity that's in a bullish market, and I can always find a commodity that's in a bearish market. So one of the things that I do is, and I've been doing it, is I've been going through the commodities market looking for some other trades. And there are several commodities that are in a bullish move right now, and several that are in a bearish move. So I want you to understand, I need you to understand fundamentally how to find a stock, how to pick a stock, how to fundamentally find a commodity that you want to trade. Because at that point, what I found with most investors is that they're terrible stock pickers. And it's not, before we start trading futures and derivatives and commodities, you have to learn how to pick things that are going higher. You have to learn how to pick things that are going lower. In this environment that we're in, and based on what I'm seeing, I'm going to say this to everyone that's listening. One, learn how to short stock. Understand what shorting stock is and how it works. I'm not going to go into the mechanics, but when you short a stock, in essence, you're doing completely the opposite of everything that you were told when you first learned about investing. The first time you heard about one of your parents or relatives say, "Oh, you want to invest in stock?" Well, you know the rule: buy low and sell high. All right. Well, in shorting stock, the rule is sell high, buy low. So in this environment, which is what we talked about, and what I'm seeing with the market in this economy, I'm expecting a pullback. I believe that I'm going to make my money on the short side. All right, that's what I believe. Now, excuse me for 1 second. I just had a brain freeze. But anyway, so shorting a stock means you believe a stock, and I'm going to use some numbers, a stock that's trading at 100, you believe is overvalued, and the stock is going to move down. All right, so you believe the stock is going to go from 100 down to whatever number it is, 90, 95, but you believe the stock's going to go lower. So what you've decided to do then to make money on that, you've decided to go short. Shorting is nothing more than contacting your brokerage firm, making sure there's stock available. You just contact your brokerage firm, let them know that you want to short a stock. Let them, or you can just put in, when you put your order in, hit the, it'll ask you if you're selling, buy, sell, or short. So you're going to hit sell, then you're going to go to the short, and you're going to short it. Your belief is that, again, the price of the stock is going to drop, and whether it be later that day, a week, a month, a year, whatever the case may be, your time frame, you're going to buy it back at a lower price. Shorting stock, your risk is you lose money if the price of the stock starts to run. If the stock goes up, you lose money. If the stock goes down, you make money. It's the complete opposite of buying a stock, or which is said to be long. Now, the reason why I'm bringing all this up is I believe now between now and the end of the year, you're going to see a major sell-off in the market. Not only in the market, but stocks along with it, which means that if we're going to make money off of this, we're going to have to make money off the downside. Right now, market's going up, stocks are going high off of light volume, so you're trading, you're going up with it. But you'll notice that you guys that are actually out there actively trading, you'll notice that when you buy a stock and it starts to go high, you'll notice that when it gets to its all-time high or close to it, you'll notice it's starting to run out of volume. It's running out of volume and running out of gas, and it's moving up on no volume. So, shorting a stock, it's the other side of the market. You're positioning yourself for prices to drop. So, I believe this bear market's going to hit again. I believe there's going to be another sell-off. I believe that if that happens, you guys need to be ready to actually go out and short stock. Now, to short stock, you can short stock, also you can short the market. So, market sells off, you decide you want to get short, great. You can go out there and you can sell short the S&P 500, which is the SPY, which is the ETF. You can also go in there, you can buy puts on the market, on the SPY, or you can actually short the SPY through your brokerage firm, but you can play it short. Individual stocks. If we have, which again, my opinion, my belief, we'll see 6 months from now if I'm right. But again, I'll say it again. By the way, if you watch the chat, I changed gears for a minute. If you look at the chat box while we're live, there's a number of my former students out there who have actively traded the market. Some have done really well. I'm looking at John Whistle. I'm looking at your comment. And John was kind enough to let you guys know that there are what they call leveraged ETFs. And a leveraged ETF, a leveraged buy means that you're buying it on, they're buying everything on margin. You can actually have a leveraged ETF to the upside. You can also have what they call ETFs that you can literally buy that are already set up to be short and leverage short. So do some research on those. We can talk about it. Look, do some research on those and we can talk about it, especially for the beginners who don't know what's going on. And if you have specific questions, I'll answer it for you. But again, there are products already built out there that you can short the market or go long the market in terms of the S&P 500, and you can get leverage on it. All right. So if you're going to short individual stocks, first thing to do, go back and look at what companies were struggling for the last year. If they were struggling before we went into a recession, what makes you think they're not going to struggle in a recession? If they struggled in a bull market, what makes you think they're not going to struggle in a bear market? If no one wanted to own that stock when the market was going high and setting new highs and just ramping up, what makes you think they're going to want to own it when it pulls back? So the first thing I look at is I look for stocks that did not participate in the bull market run. I'm looking for the laggers. I'm looking for the worst companies in the industry. I'm looking for the ones that have the lowest stock prices. I'm looking for the ones that seem to be out of favor. The other thing I look at, which we talked about, and I'll say it again, I look at how much debt the corporation is carrying. We can go into it a little later, but like you and I, we have revenue, we have expenses, and at the end of the day, if you don't have enough capital to pay your expenses, you are illiquid, you are in bankruptcy. In 2008, General Motors did not generate enough operating cash flow, which is operating income. They did not generate enough cash flow to service their debt, and that's why they went into bankruptcy. There are a number of corporations right now that are sitting there paused and probably headed to bankruptcy. They're the same companies, believe it or not, that borrowed money or got money from the federal government to make payroll and keep the business afloat. Well, those same companies are struggling. Those same companies are struggling. They were struggling before the pandemic. They got some money, but they're going to struggle during the pandemic. And when this market cracks, they're probably going to crack right along with it. So when you're looking for stocks to go long under my strategy or go short, the place you're going to hang out is new highs, new lows. So keep an eye on new lows. There's several major corporations that are setting new lows in this environment, or yearly lows and all-time lows. And a lot of them are airline stocks. So I'm not even sure if some of these airline stocks will even be around a year from now. I mean, that's just how bad it looks for the airline stocks. So again, so that's why I wanted to make sure that you guys understood that. I'm checking my time. All right. I had a question concerning, well, let me back up real quick before I go too much further. I got to go back. I talked about there being a bull market in the commodities market. Well, make sure we understand this. Bond prices and interest rates are inverse. As interest rates go down, bond prices go up. As interest rates go up, bond prices go down. Excuse me. Since the Fed has taken interest rates to zero, and they started doing that, taking rates down, they started doing that a couple of months ago, a couple of weeks ago, I should say, the bond market's been in what I call a bullish move. Bond prices have come down, bond prices have gone up, appreciation, and interest rates have come down. So over the last 3 weeks, let me get this out right. Over the last 3 weeks, the 30-year Treasury futures contract that I've been tracking, if you had brought that contract, you pretty much have seen a 100% return on your investment over the last 2 weeks. It's been interesting what's happened with the bond market. So soybeans, another one, has taken off and exploded. Reason why I tell you this is that in the commodities market, you'll always find something that's in a bull market. You'll always find something in a bear market. The key to all this is, before we even get into trading derivatives and trading commodities, is that you need to understand how to find these. You need to understand how they work. Once we do that, making money in these is going to be easy. It's actually isolating the actual opportunity that's the challenge. And I promise you, as we keep going forward, I will show you that and I will teach you that. Now, the other thing that we need to keep an eye on too is, which has been very interesting, is the VIX, VIX, the volatility index. Wall Street loves talking about the VIX. They want to talk about it's at all-time highs. They want to talk about where it's been. Another one of my, and I think John Whistle, you also, I taught you guys the VIX strategy. I know I taught it to Tommy's class, and I know Tommy's been using it. So let me explain what's going on. The VIX is a volatility index. It measures the volatility. They have VIXs now on all different indexes. The one that I use and still use is the S&P 500. So I use the VIX based on the S&P 500. And what it is, it's a contrarian indicator. So when the VIX is running at its all-time low, or running low, it means that the market is in euphoria, that everything's great, bullish, so forth and so on. When the VIX is high relative to where it's been, then the VIX is telling you, I'm laughing because I see one of my other students, I taught it to his class too. When the VIX is running high, it virtually means that there's fear in the marketplace. All right. Now, here's what the deal is. If you're going to start monitoring and tracking the VIX, compare the VIX to where it was 30 days ago. The VIX looks at 30-day options, puts versus calls. Puts in the numerator, calls in the denominator. And that's how they come up with the value. I tell this, and I say this again, to look at the VIX where it was 2 years ago does not take into account what's going on in our environment today, nor with those premiums and the puts and calls. If you're going to use the VIX to track what's going on in the market when the market's oversold, overbought, then you need to actually look at the VIX only going back 30 days and compare it to where it was a month, 2 months ago at the most to where it is right now. But to compare the VIX to where it was 6 years ago, or to compare the VIX where it was, during the great recession in 2008, is not worth your time. There are different markets, different variables in the market now that are having a push on the VIX. So for those who don't know the VIX, volatility index, When the VIX runs extremely high, typically it means the market's oversold. And again, and when the VIX runs extremely low, it means that there's euphoria in the market. Everyone thinks the market's going to go high and keep going higher. Remember, the VIX is a contrarian indicator. What that means is it's going to tell you the opposite of, it's going to tell you to do the opposite of what it's reading you. So when the VIX, let me go back one step. When you look at the VIX, ignore the euphoria. Ignore that side. Look when the VIX is at all-time highs and where it was compared, over the last 30 days, 60 days, 90 days. On the high end, and what you'll notice is when there are sharp sell-offs in the market is when the VIX will spike. When the VIX spikes, I'm smiling. When the VIX spikes off of a sharp sell-off in the market, again, we're investors. We know we're going to be wrong sometimes, but the majority of the time, over 50% of the time, when the VIX has those sharp sell-offs, the market is oversold and it's going to have a bounce back. Whether we're in a bullish market, which is going higher, or a bearish market going lower, when the VIX has those spikes, it's going to have a bounce to the other side. I couple the VIX with a 10-day moving average. And by applying those two, and when the VIX penetrates above and below, the market, not the VIX. When the market penetrates below the 10-day moving average and the VIX spikes up, I'm getting short the market. It might be for a day, it might be for a week, it might be, I don't know. I don't judge how long I'm going to play the market. But when the VIX spikes, I'm going to get long the market. When the VIX goes down and is overbought, I'm going to look to short the market when it breaks the 10-day moving average. When the VIX spikes up and the market's below the 10-day above the 10-day moving average, and the VIX goes below it and the VIX spikes up, then I'm going to get bullish and buy the market. I know I said a lot of things there, but that's how I use the VIX. So, and I've seen a lot of conversation going on in the VIX. The one thing I'll say to you guys is, again, study, look, read, and then follow how these things react. That will help you in the long run. All right, so we talked about that. There are some other indicators for my more advanced people that are listening. I've had some questions about relative strength, MACD, money flow. So MACDs, money flow, Bollinger Bands. At one point, I've used all of them. But what happened is, when you start having too many indicators that you're looking for, it means that you need a whole lot of green lights before you start to go. And so what I did was I took all my indicators that I used and I boiled them down to basically 3 indicators. And those are 3 I use. And I tracked it. As I said, I tracked the VIX. I look at volume. The other thing that I look at when on my trading, I basically look at a 10-day moving average. And for those who don't know, a moving average is nothing more than you take the price over the last 10 days, add them all up, divide by 10, and you come up with a line. The reason why they call it moving is if it's 10 days, they'll take the last 10 days. And then a week from now, they're going to take the last 10 days. So that average is moving with the time, and as we get more and more days, it moves with it. For my short-term traders, my day traders, you guys know that you do a lot of technical analysis, and that's what probably separates you. They don't care too much about fundamentals. All right, so I boiled it down to 10-day moving average, 20-day moving average. I boiled it down to, I look for Bollinger Bands on certain instances. I look at price of the security, and I look at volume. And again, I will put some videos up on my YouTube channel. So again, I'll put this up on my YouTube channel. I'll put some more videos up on my YouTube channel that explains technical analysis, shorting. I'll write some stuff up and I'll put it up there so you guys can see it. So, real quick again, let me wrap this up. In this environment, for my long-term investors, buy, hold, sit, be ready for volatility. I think there's going to be a sell-off. We can't time the market. So you have 2 choices when this happens. One, you can actually, when the market starts to correct, and you'll see it, you'll talk about it. If the market starts to correct, you can actually go to cash and sit in cash and wait. if you do, for my long-term investors, if the market starts to sell off and you do not go to cash, and you decide to ride this thing down, then once you write it down, you got to stay with it. One of the things I've seen investors do is that they say, okay, I'm gonna ride this down. I'm a long-term investor. I'm gonna buy and hold. And then they sit there, and when the thing sells off, and if they've been sitting there for 2 or 3 months, they finally get tired and say, I'm gonna sell it here. If you don't sell near the beginning of a sell-off and you ride it, then ride it all the way down. Because what's gonna happen is most investors sell at the bottom of a bear market. All right, most investors sell at the bottom of a bear market, and most individuals buy at the top of a bull market. So if the market starts to sell off and you're a long-term investor, either sell it then or hold it. All right. Now, for my short-term investors, short-term traders, keep taking your profits on these stocks that are running higher, but be nimble. Know that they're moving up with virtually no volume behind them, which means it's paper thin, which means that you could literally wake up one morning and see your stock down 15% off of no volume, and then it starts to crank. So my short-term investors, stay nimble, realize that, take profits quickly, and when this thing starts to turn and go down, be willing to actually say, okay, time to get out of XYZ stock, and maybe it's time to start looking to go short the market or go short some stocks. All right. So that's one of the things I'm going to say to you guys that are trading is that be nimble. This is going to be interesting. As I said last week, there's only been 3 or 4 times in the last 100 years that the market and the economy have disconnected in terms of the economy's not doing well at all and the market's just doing well and going higher. And eventually they will come back together because, again, the economy is what drives the market, and the market can't go higher if we as consumers aren't spending and have money. All right, and the Fed can do anything and everything that they want to move rates down to 0 and keep them down there, but it's not going to work. And the other thing too, just so you guys know, and I've had this discussion before, the Fed now is buying ETFs, electronically traded bond funds. They're buying ETF bond funds, and they're doing that to support the bond market. And again, let me go back. You have to learn how to read the newspapers and understand. The Fed came out and said several weeks ago they're going into the market and they're going to buy ETF bond funds back to help support the bond market. So make sure you understand what that means. It means that as these ETFs came down in price, the Fed, through their brokerage, through the Fed's trading desk, the Fed came in and started buying these ETFs and giving them a support. And by giving them a support, they gave the bond market support. That's what the Fed's doing right now. All right. It's one of the reasons why the bond market took off, because the Fed's helping support it and not allowing it to come back down. You must be able to look at a newspaper, and then once you look at the paper and you read the headlines, ask yourself, how can we make money off this? How's this going to affect the stock market, the bond market? How's it going to affect these markets? How's it going to affect this stock or this individual stock? Once you ask yourself those questions, you start digging, then you realize I can make money off of this. And the way I can make money, like I said, the Fed's buying back ETFs. If the Fed's buying bond ETFs, it's telling you that they're not going to let the price drop on these. There's somebody underneath supporting that. That's what I talk about when I say institutional sponsorship. That's the reason why when the stock starts to break out and go to new highs, I want to see that volume, because that's the sponsorship. Without any volume, it moves up, and guess what? It can just come right back down. That sponsorship gives it that support. All right, check my time again. I got 5 minutes. Here's what I want to do with you in these last 5 minutes. Bear with me a second. I'm going to something, and so I'm going to read you my watch list of commodities based on fundamentals. Now, understand what I just said. I do fundamentals before I do technical analysis. So I do the fundamentals in the commodities, then I go through it, I look at the fundamentals and see whether or not it's time to buy. So I use fundamentals And then I use technicals to figure out if and when I want to get in and if and when I want to get out. So I'm going to read my list to you. It's not in any specific order, but my list on the long side. And I do this every weekend. Every weekend I come up with my list. I go check it. So on the long side, and I've been long this for a while, corn. Long corn at 3.19. I'm not sure where it closed today. Last I looked, it was at 3.24, 3.25. That's $3.25 a bushel. Long cocoa. Long the Canadian dollar. Been long the Canadian dollar for a while now, a couple of weeks. This one I got, and I'm not going to do anything with it just because, but I got a buy signal in the futures for the Dow E-mini. I got a buy signal for the Dow E-mini on fundamentals. High grade copper, coffee, wheat, and my last one I always laugh is the peso. I've had a buy on the peso now for several weeks, and the peso is just did nothing but move up. I'm not sure where it closed today. It was down a little bit, but the peso. On the short side, this week on the short side, short the euro, the yen, currency, yen, forex, lumber. Was long lumber, now I got a sell signal on lumber. Lumber, got a sell signal on OJ, and I had a sell signal on rice. And here's what's interesting about rice. Rice had a major run up, spike, went parabolic. It literally went straight up. And as it was going straight up, I got my fundamentals gave me a sell signal. And before I could even do anything, rice had a major, major sell off. For those who trade commodities, understand this, rice was limit locked down for 2 days in a row. For those who understand commodities, limit lock is when they actually close that exchange and will not let that commodity trade because it's moved up or down in price too much for that point. So rice, what else? Short, Swiss franc. The other one short is I got a short signal on the Russell 2000. That's a stock index. And last but not least, I got a short on soybean, and soybeans been running for the last month, 2 months. And in fact, soybeans actually looks like it's parabolic. I'm not sure when soybeans going to break down, but I got a sell signal on short on soybean on the fundamental side. So you're looking at my fundamental list on the commodities. All right, so our time is up. It's been an hour. Just a quick reminder, I will post two things. I will post this video on YouTube in 3 or 4 days. I'll repost it on my Instagram account, but I'll also clean this up a little bit. I'll add some some websites that I used and some of the things I talked about. I'll put some of that in there, some visuals. You can actually pull this down or get this history off of my YouTube channel. So I have a Professor Milligan YouTube channel. You can track me there. I have a Professor Milligan Facebook page. Not too active on Facebook. I'm more active on Instagram. And then you can always follow me on Instagram. And during the week, if you have any questions, any issues, feel free to DM me, direct message me. And if you have some questions. The other thing I want to say to you guys is there are some people on this call that are some really good investors. People I've taught over the last 15, 20 years. So anytime you guys want to share an idea that you guys are working on, discuss an idea that you guys are working on with me, feel free. As you guys know, I don't think I know everything. I'm always open to hearing what you guys are doing to make money, so I can learn from you as much as you can learn from me. But the goal is that we need to make money. I just got another question and we'll talk about it. I got a question for those. And for those who don't know what I'm about to say, go look it up. Go look it up. Do some research. When I talk about it, it's going to be that much easier for you. But one of my former students right now is saying to me, Professor, talk about the COT. And the COT is a commitment of trade report. Commitment of trade. Go look up commitment of trade on Google, read it, talk about it. And when I talk about it next week, we can go into more detail and I have more meaning for you. But the commitment of trade report comes out every Friday. Go look it up, go read it, and you'll see it. So once again, this is Professor Milligan on my Wall Street Wednesday. I do appreciate all you guys coming. I appreciate the question. I appreciate the feedback. My goal is the same as your goal. My goal is for everyone on this call to become a multi-millionaire
through investing, increase your revenue stream, increase your family's wealth. You know, and I'm not getting into politics, but increase your family wealth. And one of the keys in this country is that money talks. And when you're involved in the market, they don't know what color you are, they don't know what race you are. All they know is your money's green. And when you take your profits out, that money's green too. They don't say, hey, Professor Milligan, you can't have those profits because you're a black man. All right. So let's all go in the marketplace and let's all start making some money and keep making some money and put it in our pockets and do a good job. All right. With that said, have a great day, and I will see you next week, if not sooner. Signing off.